Hello and welcome to Investors Guide. Thank you so much for tuning in. I'm Faye D'Souza, and of course joining us on the show this week will be Dhirendra Kumar. But before we go any further, I would like to thank you for your continued support to the show over the last 6 years. It makes us feel so positive about the work we're doing when we receive emails from you week on week telling us that the show has actually made a difference to your investments and to your lives. So continue to write to us. It gives us the fuel we need to continue this show for another 6 years. All right, let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on Investors Guide. I am so glad about the portfolio question we're taking this week. It's very exciting, and I'm sure you'll enjoy it just as much as I will. 32-year-old Ravi has written in from Bangalore, Dhirendra. Now, he and his wife together earn about 2.7 lakh rupees every month, and they spend about 50,000 rupees. So he invests the rest of that money. He invests about 2 lakh rupees every month in mutual funds. Now, he checks all of the other boxes. He has a term cover of 1 crore. He has health cover. He has an employee provident fund, which he's accumulated about 20 lakh rupees. He also has a PPF account and 40 lakh rupees in fixed deposits. Now, his first question to us is that of his mutual funds. And it's very interesting. He does seem to have picked all of his funds based on advice on this show. He's putting aside 20 lakh right now. And a portion of that, half of that comes from his wife's salary. And he says there is a possibility she might decide to stop working. But he wants to know if he continues to invest in mutual funds aggressively in the manner that he's doing right now, will he have 100 crore rupees in 25 years? Or if he continues 2 lakh rupees every month, he will have 100 crore rupees, Dhirendra. But also take a look at the mutual funds that he's picked out. Are those the right funds to hit that goal?
These portfolio of 6 funds actually make it a very beautiful portfolio, a very well diversified portfolio, and I'm hopeful that this will also insulate him. He should not look at it's important that he should not look at his individual investments at different point of time individually. He should look at his portfolio holistically. He has picked excellent funds of all kind, and without diversifying beyond a point that it becomes meaningless. So it's an excellent portfolio. And 2 lakh rupees a month for next 25 years will easily, with this kind of orientation, including the money which he has, accumulated so far in mutual funds, will easily, take him through over 100 crore if we expect that, funds will deliver little less than what they have in the last 20-25 years. But even assuming less return, even assuming that fixed income return in India comes down dramatically over the next 5-7 years, and assuming that a 17-18% return from equity will not be achievable, he will still, going by what he has accumulated so far and the the regular investments in the six funds he has chosen, I think he will be very close to 100 crore even in the worst case scenario.
Yes, another interesting question, Dhirendra, and this is something that a lot of viewers are asking us, especially in a market like this one, given the way we've seen the market run away all this week. He wants to know if by bypassing direct stocks entirely, and he has no direct stocks, he has not bought a single stock, he's only invested in mutual funds. He's saying, is he by any chance letting go of any sort of possible return or higher return that he could make by investing directly in stocks? I don't think so. And maybe it's time for you to reiterate one more time why retail investors don't have to do stocks directly and why that's not a disadvantage if you choose not to do stocks.
No, I'll just, explain it in another way, that mutual fund is a way to diversify easily. It provides you all the convenience. It provides you a convenience of investing regularly in a very structured and programmed manner. It also provides you all the tax efficiency if you hold your investments, like stocks, if you hold your investments for 1 year. Of course, I think that, if an investor can do all these things himself and do it well, I think, it will turn out to be a full-time occupation. So if you are actually busy doing your job, making a living, earning your living, so then it will become very difficult. It will become a pastime. You can do things on your weekend. You can study balance sheet, analyze things, ensure diversification, and take some time out on a business day to execute your transaction. That is the smallest part of it. And if you are going to have great fun doing it and you are confident that you can do it well, you have the discipline, you have the inclination, and you have the temperament. I think the temperament bit is the most important. So which I think, all these things combined together, which I think is essential for money management, and more so with a portfolio focused on equity, then you should not venture into that. I think the cost that you incur in buying a mutual fund is well worth it. But if you are in a profession where this could be an interesting way to enhance your knowledge, you really enjoy doing it, it is also your hobby, and you have the temperament, I think there are just too many variables, and then by all means build your equity portfolio. It's great fun doing it, and that also means that keeping away from noise. When I was referring to temperament, I mean insulating yourself from the noise and building a long-term portfolio which is not necessarily too many transactions. You don't have to necessarily be active. But my sense is that if an amateur is getting into it and has to learn all his way up, maybe 5 years down the line, 10 years down the line, because learning from other people's mistake has not been possible in investing. You have to learn it the hard way, and you may not have the time for that. So I think the next best thing which you can do is buy a good mutual fund, have most of the convenience at a nominal cost.
All right, so buy a good mutual fund, and unless you have the time and the inclination really to sit all day in front of that computer and track your stocks and track the quarterly numbers that come out and all of the news containing, pertaining to both the sector and the stock, and that's the kind of research and the work you have to do if you're going to buy stocks directly. If you're not willing to do any of that, then buy a mutual fund. And Dhirendra, one more question from Ravi. Well, Dhirendra, he does have a question that a lot of investors are asking at this point. He wants to know, over the long term, is the fixed deposit a good debt option? Because he has 40 lakh rupees in fixed deposits right now. And given the fact that we have seen our first rate cut from the RBI governor, does it make more sense to use a debt fund?
No, it always makes sense for investors to, for thinking investors who have the ability to invest in mutual funds, because buying mutual fund is not as easy as making a bank deposit where the money moves seamlessly from your savings bank account to turn into a deposit, and which will start yielding you higher return. Compare that to by choosing a mutual fund, choosing the right kind of bond fund. Of course, bond funds are not as risky, and it is particularly opportune right now to be investing in income funds, because with the rate cuts which have started, and I think it is likely to continue for a long period, because this rate cut will not come to an end this year itself. Maybe we'll have 50 basis points more, and then another, because interest rates in India are still at a level where there could be substantial room for cuts. So from that point of view, I feel that income funds will deliver sizable return in next 2-3 years, and after that the hard time will start. So next 2-3 years one should definitely consider income fund. But as I keep saying, and I would like to repeat it again, that your long-term money, the money which you are unlikely to need in the foreseeable future, 5 years and more, that money should be into equity, and that money should be invested regularly, and that money should be invested in good funds.
All right, we hope that helps, of course, Ravi, and if you need any more help or you have any more questions, feel free to write to us. If you would like us to take a look at your entire portfolio, you know how to get in touch. There's an email ID on your screen. You can also reach us on Facebook. You can reach me personally on Twitter. Let's quickly take another question. Ashish Agarwal has written in, Dhirendra, there's a reason why I've picked this question, because it's indicative of what a lot of people are asking right now. He says he's made a certain set of investments, ELSS, PPF, PF, insurance, all of that adds up to 1 lakh rupees, because that was the limit until last year. He now needs to make an additional investment of 50,000 rupees, given the added limit this year. Where should he be investing that money? So he's basically asking you to prioritize and choose between the four. I'd say ELSS. Do you agree?
Completely. In fact, I would say that most people from the old generation, all of us who were guided by our parents, we got initiated into PPF or something which was fixed income, because that was the only game in town 10 years back or 15 years back. It was not easy to buy mutual fund. The understanding about market was of a kind which was considered scary. So I would say it is important that long-term investment should be getting into equity. And more so for all tax-saving investments, you get into a lock-in of at least 5 years. ELSS provides you shortest period of lock-in, which is only 3 years. But look beyond that. Look for 10 years and more, 5 years and more at least. Simply because over these period of time, equity proved to be, the risk of equity comes down dramatically. It's only that equity is very risky when you hold it for a very short period of time and you have a very short investment time frame. The max that you could do earlier was invest 1 lakh rupee. That included investment. There are a lot of long-term commitments, and investors, because of inertia, don't intend to discontinue that. If you have got into an agreement for, with a ULIP plan or any such thing, then you tend to continue that. Your EPF is a mandatory deduction, which is also part of ATC. Likewise, any term insurance, which is a mandatory expense, that also comes under that. So I would say use this 50,000 rupee. If all of your ATC was completely exhausted, you were hitting the ceiling, then use this 50,000 to get the equity exposure, have a long-term view, choose 1 or 2 good tax-saving funds. This year, you may not have the opportunity or have as much time to spread your investments over time. So, at least stagger your investment over the next 3 months, in the 3 months before this financial year. Next year onward, spread it over the next 12 months so that you are able to average it better.
All right, so use the ELSS, and of course our selection of ELSS is on your screen right now. And you can pick any one of those funds and add it to your portfolio. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. I'm Faye D'Souza. Dhirendra Kumar is still with us. It's time for us to do our weekly fund review, and this week we're looking at the Sundaram Select Midcap Fund. Avan is here to give us an introduction. Avan.
Thanks, Faye. This week we talk about the Sundaram Select Midcap Fund. 2014 now has been an excellent year for all the midcaps, and last year alone, this fund delivered a whopping return of 83%. Beating the benchmark by a sufficiently strong margin has become routine for this fund. Since its launch in 2002, its investors have been rewarded a return of 32%. The fund manager is extremely comfortable in the mid and the small cap space and only concentrates on sound stocks with good growth prospects, good pricing power, and a stable cash flow. Backed by a strong team, he invests in companies with higher valuations where long-term growth prospects seem favorable. A bottom-up investment style has its own fair share of risk, and this fund allocates 90% of its assets to mid and small caps compared to its peers, who conservatively allocate only 70% of their total portfolio in mid and small caps. Conservative investors should stay away from this fund, as its asset allocation may result in underperformance during a rally led by large cap stocks. So, despite its above average risk and below average return, should you place your bets on this fund? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, as always, thank you so much for the really helpful information. Dhirendra, Sundaram Select Midcap Fund used to be one of the funds that was very recommended on the show. It has since then fallen a little bit from grades. It's down to only 3 stars on value research. If you look at it over the last 10 years in its category, it was on the top. But over the last 3 years, in the last 1 year, it's sort of reached the middle of the category. So it's not been a bad performer. It hasn't actually been one of the best. What would you recommend we do for those of us who are holding the funds in our portfolio right now?
I find this fund still very impressive despite a slip on the rating. And the slip on the rating is primarily because, this particular category got crowded with a lot of small and micro cap funds also, which are part of this category itself. So I would say if you're looking for, and in the 2 market cycle that it has been, it has proved its credentials despite, reasonable change in the number of people who have managed this fund. So despite change of fund managers, it has shown a certain kind of bent to, spotting opportunities, being ahead of the curve, ahead of other funds, and retained its focus. It has turned big, little bigger than many funds in this category. But I still find that, the way it has regained its, old charm, or it's regained its older times, when it used to do well. Of course, last 2, 3 years, 4 years has not been favorable for the whole category as such. So I would say that despite a slip on a rating, despite looking on the risk-adjusted scale as a 3-star fund, it is still an impressive fund, and investors should consider buying this fund or hold it if they have it.
All right, hold this fund if you have it. Dhirendra, what would be your star rating of the Sundaram Select Midcap Fund at this point?
Ideally, at Value Research, we should be splitting this category into two, which is, mid-cap funds and small-cap funds. But when when this category was formed, we didn't have too many funds there. So if I have to look among the mid-cap funds or the well-defined mid-cap funds, I will slot it as a 4-star fund.
All right, 4 stars there for the Sundaram Select Midcap Fund. A quick recap of what Dhirendra said. He said it's still a very, very good performer. Don't be as taken by the slight slip in ratings on Value Research. If you're holding this fund in your portfolio, it's an excellent fund. Continue to hold it. 4 stars for that fund. I want to quickly answer a couple of more questions before we run out of time with Dhirendra. Ravi Shah has written in Dhirendra. He's an NRI. All of his savings, he tells us, are in his NRE account, which earn him an interest of 7% post-tax. Now, that's a little confusing, Ravi, because there is no tax on your NRE account. So you don't have to calculate it post-tax. He wants to know what alternative is there that would give him better returns right now. I don't think there is an alternative for an NRI right now that would give him better returns in fixed income. But were he able to consider equity, there might be some options there for him, Dhirendra. What would you recommend he does?
No, unless until he has, long-term view, and which means a willingness to accept the market volatility, and he's thinking of, many, many years. I don't think there is a better alternative which will give him guaranteed this kind of return on a post-tax basis.
All right, so stay with the NRE deposit. That is the best option you have right now in the Indian market at least. And if you're willing, like Dhirendra said, to stay invested for the long term, then equity, like we talked about in the beginning of the show, might be a good option for you. Remember, we did talk about creating a corpus of 100 crore rupees in 25 years. So that's something that you could think about. Another question, Rajkumar Sharma has written in Dhirendra, 65 years old. He wants to know where he can invest a lump sum amount to save tax and get good returns over the next 3 to 5 years. So equity is completely out of the question for someone who's retired and only has 3 to 5 years as a time horizon. What would you recommend he does?
It entirely depends. If he has his income stream coming from his pension or investments which are providing him the income to support himself, and when he's making a tax-saving investment, he'll be locked in for 5 years anyway. All other fixed income alternatives will lock him for 5 years. So he will not have access to the money which he makes, on the investment that he makes for the tax saving. So I would say, and also there is not much time to average your investment for this tax saving for this financial year. So might as well consider your 1.5 lakh rupee investment till the coming March. Into tax saving fund, and rest of the money you should keep in fixed income. But I think it's limited information for us to provide a complete suggestion.
All right, Mr. Sharma, we hope that helps. Like Dhirendra said, it really depends on whether or not you want to generate an income from that investment. So if you're hoping to generate a regular income, then there's the Senior Citizen Savings Scheme, which is a guaranteed return. At least you know what you're going to get through the course of the year. The other option to beat inflation is to use our conservative equity-linked savings schemes. Those are on your screen right now as well. Right back to us if you need any more help. Dhirendra, thank you so much for joining us on the show and answering all of our questions. Oh, welcome back. You're watching Investor's Guide in ET Now. Thank you for staying with us. We brought in Gajendra Kothari this week to answer the questions you sent in on insurance. Gajendra, thank you for joining us. We have a lot of questions, beginning with a woman investor. Supriya has written in. She's been investing in the SBI Smart Life Performer since November 2012. Now, she pays a premium of 99,000 rupees a year, and she's not at all happy with the returns. Now, like most investors who've written in saying that had I invested in a fixed deposit, I'd be better off at this point. Gajendra, she's asking exactly that. She wants to know, does it make sense to just pull the money out and invest in a fixed deposit?
Since you have invested in a unit-linked plan, which is SBI Life Smart Performer, you have to compulsorily hold this plan for next 5 years because there's a mandated lock-in period. Once this plan is over, obviously, as you mentioned, the performance is not up to the mark because a lot of this goes into the charges. So the policy administration charges works out around 10%, which is quite high. And since you mentioned you're a conservative investor, most of the money is going into a debt investment. So if you rather come out of this fund, you may be incurring losses at this point. But if you're a conservative investor, you can consider investing in a fixed deposit, which gives you around 8.5% for 5-year or 10-year period. I think that would be a better option.
Next question comes in from Dr. Akash Salunke, who works in a pharma research and development organization. He has a term insurance cover of 1 crore rupees and he puts in 50,000 rupees a year in the ICICI Pension Advantage Dynamic PE Fund. He has enough health cover and he wants to know how else he can secure his family's future. Gajendra, I would recommend a mutual fund investment to him. What would you recommend?
First of all, I would like to congratulate you for buying your term insurance cover. You have a 1 crore cover, which is a very decent amount. Just have a look at that. Your term insurance cover should be at least 15 times of your annual income. If you meet that, I think it's fine. You should not continue with the ICICI Dynamic Advantage Dynamic PE Fund because it's an insurance plan for your retirement, but last 10 years has been 10 to 15%. Rather, a diversified equity mutual for a longer term would be a better option. You can expect around 15 to 16% return. With regard to your health insurance cover, I think you are adequately covered at this point of time. However, you need to look this from 3 to 4 year perspective, and then you can take a call whether it needs to be increased or stay continued.
Last question from a professor. Professor Kulkarni writes in, he tells us he's been investing in SBI Life's Maha Anand ULIP plan for the last 5 years. The 5-year lock-in is now up. He wants to know if he should continue with this policy or should he withdraw his money. Well, that would depend on a lot of details you haven't sent in. Professor Kulkarni, are you happy with the returns? If you can continue, ideally these plans do, show you good returns after 7, 8, maybe 9 years. So if you can, I'd recommend that you continue making those investments. Gajendra, what would you recommend?
The policy which you mentioned, which is SBI Maha Anand, it's a unit-linked plan, and in this, your money is invested into investment products, and there are a lot of charges also. Since you have already completed 5 years, which is the mandated lock-in period, I would rather now recommend you to come out of this policy, and you don't have to pay any charges, and whatever proceeds you get, this can be invested through a mutual fund, because a mutual fund in the long term gives better returns as the charges are lower compared to insurance policy, and you have far more flexibility in a mutual fund investment compared to an insurance plan. So I would rather request you to come out of this policy.
All right, unfortunately, I've run out of time on this show, but remember, we're going to be here for the rest of the year. If you have any questions at all, write to us. Email ID is at the bottom of your screen. You can reach me on Twitter as well. Gajendra, thank you so much for joining us this week. If we have more questions on insurance, we'll ask you to come back. Thank you so much for watching.